Hello everyone, so we're from Group 2A, so we will be presenting on how the impact of money supply and exchange rate on the stock market within 2013 to 2016. So, stock market as a platform for the issuance and trading of company shares and derivatives with transaction occurring through stock exchange. So the stock market is considered one of the key components of the economy containing primary and secondary markets and is crucial for economic development. So Kuala Lumpur Composite Index contains the largest 30 firms that are listed on the main board by full market capitalization that meet the requirements set out by the FTSE Bursa Malaysia ground rule. The stock market can also reflect the country's economic performance. So the stock market index reflects the capital market performance, such as how much economic activity like investing is happening at a particular period. So by understanding what affects the stock market index, investors and analysts can make better prediction in the future before making any financial decisions. So there have been researchers that examine the interaction between stock market index, exchange rate, and also the money supply. So for the government and policymakers can also use the stock market performance as a guide when introducing the monetary policies, which is expansionary or contractionary, especially when a financial crisis occurs.
Next, we are going to the problem statement of our model, which is the high fluctuation in the Kuala Lumpur Composite Index from 2013 to 2016 is affected by the exchange rate and money supply. The exchange rate of USD to MYR has remained relatively stable in the years leading up to 2014. But after the 1MDB scandal in 2015, capital started to leave the crisis country due to the investors' risk aversion and would move to stabler currencies like the US dollar when the financial crisis occurs. This causes the Malaysian ringgit currencies to depreciate against the US dollar, lowering its currency value and increasing its USD MYR exchange. Next up is the money supply. Here refers to the total amount of cash and cash equivalents such as saving accounts and physical money currencies that are circulating in the economy at a given point of time. When there are more money circulating in the economy, more money is available to invest in stocks, and you make the other alternative investment instruments like bonds less attractive. This causes the stock prices to move higher when there are more money supply in the economy. Our research objective is to determine the relationship between the dependent variable KLCI and the independent variable of MYR to USD, currency exchange rate, and Malaysia's money supply.
Okay, so now I'm going to explain about the model that we're going to use in our group assignment. And the theoretical model that we're going to use is the multiple regression model, which is y equal to beta 0 plus beta 1 x1 plus beta 2 x2 until beta I xi plus c. And then the economic model that we're going to use is the log KLCI equals to the function of exchange and log M2. And then the appropriate economic model that we're going to use is log KLCI equal to beta 0 plus beta 1 x1 is exchange plus beta 2 log M2 is the x2 plus error terms. Okay, so now the indicators for our independent and dependent variables. First, log KLCI, which is the dependent variables. KLCI itself stands for Kuala Lumpur Composite Index, which is the stock market index that measures the performance of Malaysia's stock market. This represents the natural logarithm of a variable to stabilize data variance, reduce the impact of extreme values, and improve linear relationship between variables. The natural logarithm can be useful in financial modeling when dealing with exponential growth or when the percentage change in a variable of interest has been identified. Second is the exchange. It is the independent variable that we're using. Exchange itself stands for exchange rate. It is used to predict or explain the dependent variable. In this example, the exchange rate represents the value of one currency compared to another. In our case, we use US dollar and Malaysian ringgit. And then lastly, log M2, which is the independent variable. It is natural logarithm of M2, which are the sum of M1, which is the cash in circulation, and demand deposits. And then marketable securities and other less liquid bank deposits. The use of natural logarithm can have advantages in statistical modeling. It facilitates dealing with percentage change and can improve the performance of regression models.
Moving on to our much anticipated findings and discussion. How good is our model and what we have learned from the analysis? Let's take a look at our multiple regression output generated from TView. We have used the ordinary least square method to estimate our log Kuala Lumpur composite index. The model includes two independent variables with one natural log model, which is LNM2, and exchange rate model. The coefficient for constant term is negative 4.429589, and probability value for constant term is 0.0434, which is less than 0.05, and make it significant for this model and explain the dependent variable in good way. The coefficient for exchange rate are negative, which is negative 0.170542. This is give us indicate that exchange rate and stock market have negative relationship. The coefficient for money supply are positive, which is 0.879246. This is give us indicate that the money supply and stock market have positive relationship. The probability value for the constant term, exchange rates, and log money supply are provided. The constant term p-value is 0.0439, which is less than 0.05, suggesting that the constant term is statistically significant. The p-value for exchange rates and log money supply are both 0.00, which is less than 0.05, indicating that the both exchange rate and log money supply are statistically significant predictor of log KRCI. In other words, change in the exchange rates and the log of money supply are associated with significant change in the dependent variable log KRCI. So, we get our estimate model log Kuala Lumpur composite index equal to negative 4.429589 minus 0.170542 exchange rates plus 0.879246 log money supply. All independence variable is statistically significant at 5%. Derive our estimate model. Let's dive deeper into how we interpret the slope coefficient in this model. Starting with coefficient of exchange rates. A 1 unit increase in exchange rate will decrease the stock market by 0.170542 units. For coefficient of log money supply, a 1% increase in the money supply will increase the market stock by 0.879246%. The next component, we will look at the goodness of fits. This is basically a statistical test, determine how well our sample data fit the distribution from a population with a normal distribution. The adjusted R-square value suggests that 68.80% of variation in Kuala Lumpur Composite Index can be explained by the independence variable. However, the others variation cannot be explained by other variables that are not captured by this model.
The econometric model was run through the Ramsey reset test to check for any omit variable and incorrect functional form. This is to ensure that the model is as close to a true model as possible. The test used the old R-square value and new R-square value taken after regressing the model estimated value to its other regressor to determine whether the null hypothesis of no misspecification was rejected or not. The F statistic of the reset test is 3.9264, which is lower than its critical value of 4.23. Thus, the null hypothesis is not rejected. This means that the model has no misspecification detected. After applying multi-collinearity test for both variable EIA2013 and LNM2, it is proven that there is no multi-collinearity between LNM2 and EIA2013, as both VIF are below 5. To check the normality of the distribution, we used the Harkey-Bera test. H0, the null hypothesis, is the residuals are normally distributed. H1, the alternative hypothesis, the residuals are not normally distributed. The Harkey-Bera statistic value is 1.812532, lower than the critical value of 5.991. Thus, the null hypothesis failed to be rejected. the residuals are normally distributed. The heteroscedasticity test, White test, is used to test for the presence of heteroscedasticity in the residuals of an OLS regression model. Heteroscedasticity means that the variance of the error in the regression model is not constant across observations. If there is heteroscedasticity, it can also bias the standard error of the coefficient and make the T statistic and F statistic unreliable. The null hypothesis of the heteroscedasticity test, White test, is that there is homoscedasticity. The result shows that the probability c-square for observed r-square is 0.0648. Since the p-value is more than 0.05, we do not reject the null hypothesis and conclude that there is no heteroscedasticity in the residuals of the regression model.
Next up is a serial correlation test, which is the Brooch-Godfrey LM test, where we test for the model for the presence of serial correlation in the residual of the OLS regression model. A serial correlation means the error in the regression model are not independent of each other. As you can see from the result, the probability chi-squared p-value is below 0.05 and thus we will reject the null hypothesis. In conclusion, that the model has an autocorrelation. But we can fix the autocorrelation by taking instead of OLS model, we use a new WS model. The new WS model will help to fix the model by giving us a less biased standard error.
So for the conclusion, the money supply and the stock market have a positive relationship. So this is because the more money available circulating in the economy, the more economic activity can occur. So this can increase the demand for stocks and it will increase the KLCI. So the exchange rate and the stock market have a negative relationship. So this information can be used to make investment decisions more accurately. With an understanding between the exchange rate and the stock market, investors can appropriate transactions to achieve their investment objectives. I think that's all from our group. I hope you guys enjoy watching this video.